What's up, everybody? Welcome back to another episode. I know it's been a while. I'm very sorry. Things were pretty busy around here. And yeah, happy to be back, and not so happy about the topic that I want to talk to you today, because I think that we are reaching a critical phase in the markets. Usually I don't talk about markets and where I think the markets are going, or I'm not some kind of macro investor, but I think that there are obvious signs that we can expect sooner or later some correction, and I just want to be prepared for the worst, and I just want to inform you about my thoughts, what I'm thinking. Always, as you know, feel free to challenge everything. My ideas are definitely no investment advice, especially what I am telling you I will do in the end to hedge my portfolio and to prepare for a major correction. But yeah, let's just jump right into the video. Today, everybody knows September 11, 20 years later. We all know what happened 20 years ago. It's really already 20 years ago. I still can remember I was walking through the town where I come from, very small town, and my girlfriend back in the day, she called me and said, "Hey, have you watched the news? Have you seen what's going on?" And I was like, no, because I just came back from school, and then I turned on the TV and it was all over the place. Like, think no need for retelling the story. Everybody saw the news 20 years ago, right? Except some people probably didn't watch the news, and I'm referring to the younger generations, the millennials, the millennial money, the millennial investors. Very interesting. I have a guy working at my company, two guys working at my company, 23 years old, 25 years old, very smart guys, very, very nice guys, intelligent guys. And thing is, recently we talked about, hey, I was talking like, hey, you guys still remember, like, what do you think about the market? Like, every one of those two is investing a little bit. And I was starting to tell about, yeah, but you remember in the end of the 90s, early 2000s, remember when the two planes hit the World Trade Center, and they are like, yeah, we've heard about it, but basically we were just 2 or 3 years old, right? And I'm like, wow, damn, I'm fucking old, right? And so it's kind of a weird disconnection, because looking at the situation now and remembering what happened back then, and also afterwards the stock market crashed, and the financial crisis 2008, 2009. I mean, I wasn't in the market, I wasn't invested because I was young, I didn't have much money. And so investing was something I was always thinking about, but never got into the action. Like less with a couple of bucks when I bought some 100 shares of, I don't know, some company, invested 1,000 euros, and so. But the thing is, you can read about anything and you can study anything. But what the younger generation and the younger generation of investors don't have are some kind of let's call it emotional scars that you still remember, that are so like burned into you, that you still know how the pictures looked like 20 years ago, or what you felt when you saw your investments or the investment fund that your parents bought for you for 10,000 euros just going down to 500 bucks. I remember very much, because my parents, they bought this kind of growth investment fund from a banker. Everybody was investing back then, although my parents didn't have any clue about stock picking or investing in the market. It was just like, hey, everybody's investing, everybody's making money. And I still can remember my dad sitting in front of the television looking at the video text, right? Like super old school, checking the stock quotes, and taking the phone and calling our banker and telling him, hey, buy now 100 stocks of this, 100 stocks of that. And half an hour later, he was calling him again. Okay, now sell. It was like, whoa, my dad's really a stock market genius, right? Basically, It was just the time when everybody was investing, and no matter how good you were, how professional you were, everybody was picking stocks. And I feel like that we are in the same situation right now, especially the younger generation. Everybody became greedy, and it's a good thing. Like when things go up, of course you can be greedy, but there comes the point when everything is so good that you feel like, okay, you know, kind of time to prepare for a change. And I also know that when the market is going down a little, and there are some people like, I mean, there are this permanent perma bears, like crash prophets and so on, like always predicting that the market's going down now and we have reached a major turning point. Like, I don't know. But what I really think, and I'm getting nervous now, is because the signs for a correction are getting more obvious, even to macro amateurs like me. Like, I mean, I think I understand the basics, but I'm not an expert on it, and I would never bet on the change of interest rates and so on. But you know, when you got the feeling and this kind of weird feeling in your stomach that things are about to change, and we've been in a very, very long bull market for a while now. But yeah, there we go. What I wanted to show you is like this graphic on the Visual Capitalist. It's a very nice chart of all the bull markets and what happened starting from the 50s with the S&P 500. I don't want to go back too far, but where we were here, like the great expansion, right? Ending with the dot-com bubble and then major crash. We had the time until 2007, 2008 and 9, until the financial crisis hit. And unfortunately, this chart is already, I think, 3 years old. So we are missing something here, right? Because the post-crisis bull run, yeah, how did it work out? Well, I'll show you how it worked out. It worked out like this. So when we are looking here, this was the dot-com bubble, right? With the NASDAQ just like going up crazy, going down, got the bull trap here. Everything is going back to normal, right? And then major drop. And we had this slow run up until the financial crisis, boom, major drop. And now, since then, the post-crisis bull run, right, up here. Then we had a dip here in the 2018. Up here, we know what happened here. February 2020, March 2020, major COVID impact. Boom, market goes down. And then we had all the stimulus coming, all the emergency finance and whatever kicking in and running directly into the stock market, just pushing it up to all-time highs. And you see how this dwarfs the dot-com bubble in a major way. And I don't want to go too much into all the macro factors, but I don't have to tell you that the money printers were on, and the dollar volume that is out there just increased tremendously. Like billions were printed and put into the market. Everything ran into the financial markets. And so now we are here, like at all-time highs. Things are getting back to normal on an economic point of view, from an economic point of view, but we also have this kind of, how is inflation gonna turn out? Is it permanent? Is it just temporary? What will happen? When do people get nervous? And this is what I really want to talk to you about. And when I read something like this, I mean, when you have this frenzy and everybody's going crazy and there's stocks only go up, right? That's the new paradigm. And whenever people talk about the new paradigm, and whenever you have meme stocks, whenever you have the markets hit the front pages of every news, and when friends of you coming along and talking to you about stocks, and you know that those people were never interested in stocks, then you know things are pretty heated. Like, it has been the same narrative for the past run-ups and then the major crashes, when everybody's starting to talk about stocks and when everybody's investing and when everybody's seeing everyone getting richer and they're fearing of missing out, then this is when you get nervous. And then when I read something like this, what's the GME endgame story? The squeeze theory at its core hinges on hedge funds needing to cover a massive short that includes millions of synthetic GameStop shares. When it eventually must reconcile, the share price will moon to 5k, 50k, 500k, etc. per share. Some even believe a single share could reach millions of dollars. Like this, that's what people talk about, right? And I mean, I get it that I was into the GameStop story until January 2021, and it was almost a 10-bagger for me. I went out, in hindsight, I went out way too early, could have made 10 times more. But I didn't, right? So I did well, but this game has crazy. And why are you still talking about a squeeze? That's interesting to me, because I think it already happened and the stock went up to almost $400. And I think that the highest price point intraday was something like almost 500. And where do you think those synthetic shares are in some kind of, I know the dark pool, I know all these theories, there are still the bad hedge funds and so on. But guys, I mean, at the end of the day, it's a company and it has to return value to the shareholder. So at the end of the day, those short-term price movements and a short squeeze, that's not a long-term event. And we got those guys very good. The GameStop stock was shorted to 140%, I think. And we just hit those guys right in the nuts, right? And everybody who was in the market or in the stock should have made a reasonable amount of money. But when you look at the Volkswagen squeeze back then, I mean, that was one of the biggest squeezes in history, and you see what happened. This is a short-term event on the chart. The stock stays at a high level, but it doesn't resolve upwards. It doesn't resolve sideways. In the longer term, you need to figure out where will the stock go based on its fundamentals. And the fundamentals will always win in the long term. I mean, all the short-term traders, all the Robin Hooders and so on, it's fun in the short term. I get it. But let's just look into some other statistics, okay? So we are at 190 and the market cap is 15 billion. So let's say this stock goes to 500, right? 500, that's 2.5 times the valuation. So we got 30 billion, 37.5 billion. That's a lot. That's a lot for a company that doesn't make a profit right now. And the thesis, and I'm very aware with the thesis. I really like that people are working their butts off on doing the GameStop due diligence. Rod Elsman, everybody who is like publishing their thesis and coming up with very, very good ideas. And I think the price target of the bull case was 160. We look at it in a little, but the thesis has to work out. That's the case. And now it's a fun game, and it's very, very dependent on trading volume and the short-term trading effects. But in the long run, at the end of the day, it's an investment in a company, and you wanna get returns. So talking about the short thesis and the short squeeze and everything, I can remember looking at this statistics. Short percent of float was over 100%. Now it's 17. How do you think a short squeeze to 5,000 will happen? So we got, with the share price of 500, we got a market cap of 37.5 billion. With a 5,000, it's 370 billion, like half of Tesla. And we talk about GameStop here, right? And the share price of 500K or a million. Okay, you guys are getting ridiculous, I'm just telling you. This is a chart, and I think that the squeeze happened, and now you are here in the very bullish scenario that Rod and these guys have pointed out, and you should really read that. I mean, there is a lot of fine ideas, and there's a lot of thought into the new GameStop thesis and how GameStop can be restructured and reinvented and digitalized, and just so many possibilities, and going into the digital age with this former retail chain. I mean, it's just great. But 5,000K a share, 500,000, it's just not happening. But you see, like, there are people actually talking about this, and I've read some masterpieces on Twitter and on StockTwits and on, of course, on Reddit. It's just everybody. How do you say, like, this community effect? Everybody's talking about it, and this guy has an idea and comes up with some conspiracy short hedge fund eat the shorts thesis, and there's the dark pool, and so much mystery, and there have to be synthetic shorts out there that have to be squeezed extra. Like, come on, right? Totally not buying your story. Also, AMC. Reading the same thing, shares hitting tens of thousands of dollars. I mean, this is a share price of 50 times 100. Let's say 5,000 a share. Like, that's 2,500 billion. That's 2.5 trillion market cap for a cinema chain. That is making what? Are you kidding me? With all the competition from Disney Plus, from Netflix, from everything, you have seen Disney can decide if they want to put a movie into the cinemas or if they just stream it on their platform. What was it? Black Widow? Scarlett Johansson suing the company, suing Disney because her bonus was tied to box office results, and whoa, what happened? No box office, huh? So sorry that I'm sarcastic here, but I'm just thinking that we are at a point where things are just going crazy and everything is getting higher and higher, and different stories for different new all-time highs. It's just going crazy, and the short interest. I mean, with AMC, it's the same. Like, it's the same short interest as GameStop. What do you think will happen with the 18% short interest? Like, yeah, you can hurt the shorts a little bit, but it got harder because now you're not talking about a $1 billion market cap or a $2 billion market cap. Now those have market caps of 12, 13 billions, or in AMC's case, 25 billion. So how much money do you have to move to now really trigger a squeeze from the last 18%? I mean, you need 10 times the money as before. And how do you get that? I mean, all of the retail investors, when everybody has a couple of thousands to spend, it's just not enough. It's not enough. That's what I'm saying. And it's hard. But the stories are out there, and people still jumping into the stock using money they saved or money they borrowed, and jumping on a GME thesis and then to an AMC thesis with a share price in the thousands or in the 5,000s or in the 500,000s. This is just this is blowing my mind, actually. What we've seen here, I mean, the squeeze was already there. We're here again, but it will resolve, not upwards. Anyway, talking about high valuations and how things look like. Talking about have we reached the pinnacle of the current bull run? I don't know. I mean, you never know, because you have to look into the future, and everybody knows how hard this is. It's the only thing that you can make is from comparisons with past crashes, with past bull markets, and how they resolved and what happened. But there is one pattern, and I will show you later. When we look at Bitcoin, I mean, this massive run up here to the top, going down like a rebound here. What's happening from here on? I really don't know, but I'm not very optimistic in this case. Also, when I'm looking at everything that is tech growth, Cathie Wood's ARK Innovation ETF, it's the same story. Big promises, huge profits that are far out in the distant futures are priced in here. So people are expecting a lot, and we went down here. Just comparing it with Bitcoin, it's the same, and then you have to wonder, like, why are Bitcoin and all the growth funds and everything, why are they so correlated? This is almost a perfect reflection. And what is she saying? We can't be further from a market bubble. Cathie Woods. Why is she saying that? Well, I don't want to say that she has no idea. I mean, this is a very smart woman, and she's been a very successful investor, not only with her ARK funds, but also before. Like, she really is a brain. But I wouldn't. What you cannot exclude is that she also is biased, right? I mean, she had this massive success when things were going up, and of course she has not the first interest to tell you, well, I think my story is over here. And you have tons of money in my funds, and I think we are going south, like in a major way. Like, what would happen? People would withdraw or would sell their funds, would sell their ETFs, and just tank the price, and then the story is over. So of course she has to stay optimistic. I don't know. It's hard to tell, because I can tell you the future and she can't. Her arguments make sense when she's saying, well, we are not like comparable to the .com bubble because the things were super crazy back then. But she's invested in like I think 5 major industries and 14 different technologies. I think those are the numbers. Like, I'm very, very sure that she will be right on the many companies that she's invested in the long run. And of course, the new technology where she's focused on is it's mind-boggling what just happened in the past few years from a technology point of view. But I really haven't figured out the use of blockchain, but I figured out the use of robotics and look at biogenetics and everything. Like, those will be major industries, and you have to pick the winner right now. And I wouldn't be able to do it. I hope she is, and I hope that she will be right in the long term. But we are talking a correction and potentially crash because of a whole set of different factors playing a role here. And what I'm just saying is everything is just too good to be true. And I think, although I respect that woman, and I think that she's very intelligent, I think that I wouldn't take anything for granted what she's saying right now, because she has an interest in keeping her funds interesting. So the next thing, Tesla. I mean, I'm not a big fan of Elon Musk. He's like, I respect him for what he's doing. I mean, no doubt about that. I don't like him. I don't like his promises. I mean, he's the guy that he has had remarkable achievements. But it's just everything is too much. Like, he's trying way too hard to pull out a new rabbit from the hat every couple of months. And when I was watching the AI day of Tesla, I mean, this was like, come on, now now you're doing what? You out of you started as a car company. Okay, you have this totally awesome rocket company. You created PayPal. But I don't get the whole Tesla case. I mean, it's a energy company. It's a car company. Now it's a quantum computing super microchip innovation company. They are building androids, robots, like freaking cyborgs right now. Just wondering, I mean, what is Intel doing, right? I mean, Intel is just working on new computer chips, new processors. Like quantum computing or artificial intelligence chips is nothing that just that came up 6 months ago, and Elon Musk is the first to jump at it. But he pulls rabbits out of the hat. That is what I'm saying, because at the end of the day, like those are highly specialized companies. And why is Tesla a champion at everything? It just doesn't make sense. It would be too good to be true. And what are the other guys doing? So the thesis for the robots is they will do boring work. Okay, what is that boring work? Will they cut onions? Will they work in logistics centers? What will they do? Will they work on cars? Like, of course, but then I wonder, what are other companies doing? I mean, those guys, like Boston Dynamics, they got freaking T3000 already jumping around on a parkour, right? So what are they doing? Like, if there would be a massive need of those kind of robots, like they have it, some kind of, and I think those are smart people. And if you talk about logistics centers, well, those are already highly automated, and you don't need freaking cyborgs to jump around and take boxes and letters and sort them from one box to the other. I mean, have you watched some videos of an Amazon fulfillment center? Have you watched like some basic logistics center? There are robots. They are not super highly sophisticated parkour running cyborgs. It's just platforms rolling around, arms, robot arms packing stuff, taking boxes, putting them from one place to the other, and you don't need more. And those robots already replace people for freaking boring jobs. So what do you think? What do you think is the purpose? I don't know, and I think that those guys are much more advanced. And when we look at those Boston Robotics guys, from what I've read, I think Hyundai is a big shareholder, and they are also a car manufacturer. So why is it only that Tesla would be able to do stuff like this? Hyundai is making millions of cars. They have the robo technology right now. Why isn't their stock price, or I don't know if they even have a stock, why is nobody talking about them? And if they are invested in those kind of robo companies, why didn't they come up with something like this? Maybe because they are not visionary enough. Maybe our savior Elon can do anything, and he's got so much brains and so much ideas, and he's hiring the best people. I don't know. It just seems too good to be true to me. Yeah. So these were some examples I wanted to show you. Like, stuff doesn't make sense to me anymore, and what is attracting people to the stock markets and to the narrative of ever going up charts and profits for everyone and the rainbow world. It's just those kind of environments where I get very cautious. I hope that things move on. I mean, I still have a couple of stocks, tons of stocks, and I'm very long-term bullish. And I don't think that we are getting into a major world crash that will just wipe out all the wealth of humanity forever. I'm just thinking about a short-term correction back to normal because things are overpriced. And why they are overpriced, I highly recommend this video. Jeremy Grantham, manager at GMO, a billionaire investor, I think also financial historian. Like, this guy does nothing but reading books and studying the past on financial markets and so on. So he's in this video, from what I think, I really do not take everything from everyone, but when an argument and when a story makes sense and it's logic, I really pay attention. And what he's saying is just something that initially confirmed what my fears were, but he put it in much better in a much better picture and explains it a lot better than I would ever be able. And he also has the historical backup to do so. And yeah, he's got a big track record. I mean, incredible video, and very. I have heard it, or maybe it's just sound with seeing that picture of those two guys all the time. But I listened to it like 3 times in a row because it was just so much information that totally made sense to me. And he also wrote, I mean, it's been a while ago, and he wrote it in January, Waiting for the Last Dance, where he's talking about the indicators that we are in a late stage major bubble. So you can also read his thesis, and basically what he's talking about is that we are in not in an equity bubble, but in a bubble in 3.5 categories, meaning housing prices went up drastically, stock market, I mean, we were just talking about it. Also, bond prices are in a bubble, and the other half is a big part of the commodities went up pretty massively. So, and his thesis is that it's very hard to get out of a 3.5 category bubble without a major correction. I mean, when you talk about a bubble, you have to talk about a correction, right? And he thinks that it will be massive. And in the video that I showed you on in the last tab, he's also putting it into words, and he's thinking about a 50% decline. He's also saying that we might have still an uptrend ahead of us, but that would be just a bonus on going down to the 50% 50 from where we are now. So this is, but he's being honest. He's saying, well, that are his thoughts based on his analysis, and he doesn't know when it will happen because nobody knows. But he's pretty sure that it will happen. So the indicators that make kind of sense for watching and explaining why we are in an overheated market. Let's look at the price earnings ratios of the major indexes. The S&P has a price earning ratio ending yesterday 31. It went down a little bit. But the NASDAQ, we are on a price earnings ratio of 36. And this is also pretty high. I really can't, I don't know if that's a typo, but the Russel 2000 valuation on a price earnings scale is 290. And it's really hard to believe. I mean, maybe someone made a mistake, but if that number is true, I mean, all the Russel 2000 companies are just in a major overvalue situation, because who would pay like 300 times earnings? That's the inverse of the price earnings ratio is your dividend, your earnings yield, right? So when you have a price earnings ratio of 33, that would indicate that you have an earnings yield of 3%. And when you have a 330 price earnings ratio, that would be 0.3%, if I'm right with the tens here. Who would invest in a like those are not major companies for the most of it. So this is tough. Hard to swallow pills, right? S&P 500 price earnings ratio versus historical average since 1950. I mean, this chart says it all. Internet bubble boom, 132%. September 3rd, 2021, 59% about average, 95%. What's wrong with the numbers today? Yeah, so it has been once in history that we crossed that line, and you know what happened then. And if you didn't live, or if you were super young to remember, and you don't have the emotional scars to see your equity or your parents' equities just dwindle in the dot-com bubble burst, then you don't really feel that kind of thing. You can read it and I can point it out to you, but you probably are not as cautious as I am, because I've experienced stuff like this when I was 16, 17 years old, and you remember that stuff. So yeah, here we are entering dangerous territory. Also, the Buffett indicator, putting stock market valuation to GDP, is the highest ever. So yeah, let's look here. We are here 2008, 2007, and we were just right here above the historical trend line. Boom, stuff went down. Now we went back, bull market. But where we are right now, this one is just like, it dwarfs the dot-com situation from that kind of indication. And that's what I'm trying to sell. I mean, the signs are getting real, and I'm getting carefully. Also, recent article, August 24th, on Fortune. Investors are borrowing less to buy stocks, and that could be a bad sign. Yeah, because let's look here. Here they point to a chart posted by this guy, Randy Frederick. Margin debt is mostly tied to market performance, but this month it declined for the first time post-COVID despite new SPX highs. This reduces the risk that a pullback becomes a full correction, but it also implies investors are getting more cautious. And when investors are getting more cautious, you want to think about big money is getting more cautious, not millions of retail investors with a couple of thousand. Those are usually the last ones to get cautious, but the big money, and when they are pulling out, when they are moving big cash out of the market, then you will notice soon enough. And if we look at the chart on detail, then we see that the margin debt in the system just went up since all of the stimulus was injected into the economy after the COVID crash. The major COVID crash right here. So going up here, and he says margin debt, what does he say? Margin debt is mostly tied to market performance. I'm not an expert on this, but let's just twist those two facts. Could it be possible that market performance is also dependent on the margin debt that is in use? I mean, it's kind of a self-fulfilling prophecy, because when you are using margin debt and prices go up, then your assets, your stocks are more value as a and your broker is willing to lend you more money. So when things go up, you use more debt, things get appreciated, get more valuable, and prices go up until they go down. So is it one responsible for the other? Or is it just the other way around? I don't know, but I think when we look at this chart, those things are very correlated, almost perfectly from my point of view. And so in July, for the first time, margin debt was going down, and the S&P 500 was still going up. But that is an index. But when we look at some individual stocks, for example, Tesla, well, I mean, it went down here. ARK Innovation Fund, it went also down from June to July. If we look at Bitcoin, it went up again here. but it went down here. And I really am not an expert on what's happening first. But I think when you don't just look at the S&P 500 index, but when you look at certain very highly valued stocks or equities or cryptocurrencies, then you see that partially that leverage that has been taken out of the market has affected some asset classes, or the price decline of those asset classes has impacted margin debt. I don't know what comes first, but from here, I think, and looking at some other signs, you want to be alert. Also, September 8th, a European Central Bank to kick off its tapering debate as high inflation surges to a 10-year high. In Europe here, tapering is already starting. In America, the Fed officials say bond taper could still start this year. I mean, when the Europeans started, takes balls from the Fed to not also start. I mean, those two big central banks, from what I've read and from what I've experienced in the past years, usually go pretty much hand in hand. Although America comes first when it comes to the financial markets, because it's just that's where the financial markets really came from, right? That's the USA. But it's just interesting. I mean, the ECB started. What will happen to the Fed? And when we're talking about when the ECB is fearing inflation, then we also think about higher interest rates. And this article asks, will the Fed raise interest rates in 2021? So I mean, the signs get, I don't know, just doesn't feel so good. And I mean, the inflation in commodities, we have seen it. Inflation in labor costs, that's not going to be temporary. I mean, why do you think people will get back to, if it was temporary and you get a raise in your somebody's offering you more money to work for him, so 6 months later you say, hey, I will do the same job for 10% less? I don't think so. Also, why would consumer goods get more expensive? Those companies have no interest in making them cheaper again. And even if the price doesn't rise, then we have also the downsizing of the goods that you're buying, right? Roll of toilet paper, not anymore 220 leaves, but only 200. So 10% price increase per unit, per paper leaf, per paper sheet. It's like, or you don't get your mac and cheese box with 400 grams, but only 380 grams content. So this is that change is here to stay, and I think the central banks are running out of ideas and of measures to just counter it. So they have to just look at what happened in the 80s. Super high inflation, and what happened? Interest rates rose to, I don't know how much percent, but I think wasn't it over 10%? And this will tank the stock market. So to sum it all up, everything that I just said here, I wanted to just give you a big picture of what I think. Look at some companies, ETFs, charts, indicators, stuff that I'm worried about. Everyone has usually seen this chart. So isn't this a one-to-one on Tesla, on the ARK ETF, on Bitcoin? So when I look at it, I feel like we are here, and I really hope that this doesn't happen. But the past has shown that those things happen, and those things lead to major corrections and crashes, and a lot of bulls will lose a lot of equity value unless you take some kind of protection or hedge, or you sell out and keep more cash. But it's psychologically hard to do. So because why should you jump out of your winning streak and just hoard cash and wait until stuff goes down so you can buy it again? It's very hard to do. So what I'm doing, and this is a very, very risky strategy, I think, but it makes sense to me, kind of. Have you ever heard of inverse leveraged short ETFs? I know there's a lot of major things going on with them and the things you have to keep in mind. But when we look at it, the ProShares Ultra Pro Short, it has declined massively because we were in a major bull run forever. But when you look at the ProShares Ultra Pro, this went parabolic. And the thing is that those ETFs are adjusted on a daily basis. So if it goes up, like this one is 3 times leveraged. So the NASDAQ goes up 1%. This one goes up 3%. If the next day the NASDAQ is going up 1%, this one will also go up again 3%, but it's compounding on a daily level. So this makes it very interesting, and it really sucks. Like, the worst thing for those funds is when they are moving sideways, because volatility will hurt you. But I'm thinking about a major downturn and a correction that might happen over a period of a few months or one and a half years, maybe, I don't know. But this is something I take in mind, I take into consideration. So this is what I just explained. It's adjusted on a daily basis. And what happens if you have an upward trend? So here we see a daily compounding of your returns. And when we are on a downward trend, the same thing happens in reverse. And when you have a volatile market and it's moving sideways, then usually if you went back to normal, you would be at around a minor percentage change, like 0.25%, but the fund is, the ETF is down 1%. So this is not the best scenario. And so people are scared about it, and it's usually recommended to just use it on a daily basis for a daily hedge and so on. Yeah, there's the compounding risk. If things go the other direction, then you compound against you. You also have derivative securities risks in those funds, because those are highly synthetic derivatives. Correlation risk, short sale exposure risk, of course. And you also have something like a timely decay, because those funds also have fees, and the daily adjustment costs money. So they are something like a negative carry kind of investment, with a lot to keep in mind when you use them. But why I think it's interesting, here's an article on Seeking Alpha that you should read, Leverage ETFs for Long-Term Investing, stating exactly what you see here in the graphs. If there's a major trend that goes on for a long time without major corrections or a shift just in the other direction, so the correction will hit you very hard. But if you have an uptrend again that is for a very long time, then these things compound like crazy. And so I'm using them, and I bought not only the leveraged ETF, but options on them. Because if things go down, like we have seen over a couple of days, as it was in March 2020, things go down. The inverse leveraged ETF goes up, compounding on a daily basis. But when I have options on them, this is even more leveraged. So what I'm trying to do is, I have a big portion of stocks that I'm very bullish over the long term, but I only have to use a fraction, or I can build up a fairly small short position with call options on an inverse leveraged ETF. So things go south over a longer period of time or very rapidly. Like, this is an overproportional protection from my point of view, in case none of any major other risks just blows up the ETF. So very risky strategy, and I just want to be safe then sorry. Also, when I'm taking another risk here, but compared to the amount I have in stocks, to the amount I'm needing to hedge myself for a major correction that might occur over the next half or 1 year or 1.5 years. If it happens, I'm betting on a longer downtrend, and so this might work out pretty well. But it's very, very risky, and it shouldn't be. This is just something that that I'm doing, and I'm really curious on what you think about that strategy, and you can really let me know in the comments if you think it's good, if it's smart, if it's totally plain stupid, if you know about any risks that I haven't considered right here. But this is something that I'm keeping in mind, because to sum it up, what I want to tell you is, I think that the signs are getting clearer for a major corrections. Very successful people with a track record and with a lot of experience are seeing the indicators and they start talking about it. It's just time to get cautious, I think, and time to really prepare for some messed up stuff that might happen in the near term, or maybe it just doesn't happen, but who knows? It's looking into the future. The future is unsafe, but this is an approach I'm taking to just keeps my head clear, and where I think, okay, if things go up, that money will be gone in the options from the leveraged inverse ETFs, but my stocks will also go up, so this will be okay. And shit hits the fan, then I have some major protection, I think, against it. So let me know what you think in the comments. I gotta go out with my lady, and yeah, hope you have a nice weekend, and talk to you soon in the next video. Take care, everybody.